My name is Richard Minney. I'm Chief Product Officer for Twenty5, and I'm here to talk to you today about 3 pricing myths that will cost your company millions of dollars. Number 1, customers will choose the cheapest price. Customers, first of all, buy from people they like and from people they trust. Certainly when you're in a service-based business, complex engineer-to-order-based business, project-based business, selling a large complex deal to perhaps a large company, those are the overriding deciders for price. And the actual price itself, of course, they'll go through a competitive RFP, they'll compare vendors side by side, but by no means will they go with the cheapest option. In fact, someone that's much cheaper than the other vendors, they may just ignore that one because they don't think they can actually deliver and it presents too high a risk. The second myth is that cost plus or time and materials are safer and better pricing strategies. It is true that if you don't really know what you're delivering, cost plus and T&M are safer in the sense of the risk of overrunning on delivering the project is transferred to the customer, not to the supplier. In other words, you bid 1,000 hours to do something. If it's cost plus or T&M and it takes 1,200 hours, fundamentally you get to charge for 1,200 hours. That, however, is the myth, where the myth ends. Because 2 things you don't think about. The first is that the customer always has a budget. Maybe they put aside 1,100 hours, 1,200 hours, 1,400 hours. They have a fixed budget. The second is a premium. When you transfer risk to the customer, you're giving away margin at the same time. You're transferring money to the customer, because the customer gets paid for taking on that risk. So what would have been a $100,000 project on a cost plus or T&M basis becomes a $200,000 project on a fixed fee basis, because now you're offering to do it as a fixed price. Customers not thinking about how much am I paying per hour and what would the salary be for the type of person you're bringing to the table. They're not thinking like that. They're thinking, oh, 200K, fixed fee, budgeted, approved, done, guaranteed. So the third myth that people believe, especially in a competitive RFP situation, is they have to be the lowest cost bidder to win the deal. It's a bit linked to the first point, but it's now when you're in a competitive situation and you think, oh, I better be under these other guys. That's not always true. First of all, if it's not your area, you're trying to make a strategic move into a new market, or you're a tier 2, 3 vendor and everyone else is a tier 1, you better be way under to be considered. But more importantly, if you can differentiate yourself from your competitors in other ways, non-cost ways, you can win the deal even if you're over. So if you've got a better brand, if you're perceived as the quality provider, if you're perceived as a safe pair of hands, if you're trusted, back to the first point, just having better references, better case studies, better client history, you've done the work, you're just seen as the expert, now you can actually charge more than the competitor and you can still win the deal. So in summary, there's 3 myths that could cost you a lot of money. The first one is that the customer will always buy the lowest. The second one is that go with a cost plus or T&M approach to transfer risk to the customer. And the third one is you have to be competitive all the time. And the opposite, which is when you can do value-based pricing or outcome-based pricing, is now when you can start to really expand your margin. If you can think about ways of packaging your service or your project into something that's more repeatable and measurable and definable, now you can start to define value to the customer. Not only does that allow you to increase your price, but it also allows you to reduce your risk of delivery, because now you've got a planned way to deliver that service on a repetitive basis.